In this session, we're going to discuss about the Indian airlines industry and broadly how do we do a sector analysis using the data that is available around the industry and comparing data points about various companies and looking at those. So as you begin the session, standard disclaimer that this is not a recommendation to buy or sell any stock in the sector. This is just for informational and educational purposes. The first step in any sector research or analysis of any data point is that every research should be creating a curiosity in our mind. This should be to identify the next set of questions around it and answers to them. And do remember that what basically differentiates a good research versus a not so good research is the ability to ask relevant questions and keep asking more and more questions as you go along. So it's important that we look at what questions are being asked about the particular research that we are doing and not necessarily the answers. Sometimes we don't have the answers, right? I don't know where crude prices will be 1 year down the line. But it's important to ask the question that how important are those to, let's say, the industry, if we look at that, right? So that's something that that we'll have to look at as we go along and try and understand it. Now, when you analyze the airline sector, obviously there's a standard set of questions that come to our mind. And there could be a second set of questions, there could be a third set of questions, there could be a number of questions that will come. Eventually, research is endless, so you could keep asking questions as you go along, right? So we'll try and cover a few of them today, and then as we go along, leave the stage ready for any further research that you want to kind of take up in this particular session, beyond this particular session. So the first set of questions that would come to your mind would be, what are the dynamics of the airline industry? And basically, how would you see that an airline makes money, right? You would also want to look at what are the major costs, what kind of products do airlines offer, what challenges does an airline face, is there any regulator in the industry in India, and what is the likely industry structure. So first things first, I think there is a regulator, and we're aware that the regulator is called DGCA. There's a website of DGCA, Directorate General of Civil Aviation in India, and you do get a website and a lot of data around the industry. The good part about the airline industry is that there is a lot of data which is available and data which is publicly available, right? So you can basically get data around airports, data around flights, departures, aircrafts, various companies. In terms of their operational data, a lot of it is available on the website, and it's available on the website of DGCA. So if you go to the DGCA website, there is a section on statistics, and you could basically find out a lot of data there. So this is what the DGCA website would look like, and there is this tab called statistics right in the middle of the page, on which if you go, you could basically get a lot of data. This handbook of civil aviation is useful. Air transport statistics are useful. You can get monthly statistics airline wise in terms of what companies are up to in terms of their operations, passengers, departures, number of flights, kilometers traveled, cargo, what tonnage is being carried. All of that data is actually available on this website here. So just go to the statistics tab on DGCA website and you'll get all the data that is there. Right now, that's the first part. Now, what helps an airline make money? So to understand this, we'll just go and quickly take a grab of an airline industry's players P&L. And if you look at the P&L of Indigo, there are broadly 3 or 4 different kinds of revenue items that are there. So passenger services obviously are the tickets, and that's the largest component of their revenue. You have cargo, you have tours and packages. Sometimes you see them booking sort of entire tour for you in terms of buses, in terms of taxis, in terms of hotels, etc. In-flight sales, some other data points that are there, some other revenue streams that are there. Primarily, passenger services are the major revenue portion for any company. And for this particular company, in-flight sales is also a reasonable proportion, and cargo is obviously the second largest one. Cargo is growing reasonably well as well, right? So that's how an airline makes money. How does an airline lose money? Or when I say lose money, basically, how does an airline basically give, where does it spend money, right? So if you look at the major costs that are there, then you will look at the data around airline fuel expenses, which is the largest cost. So that's your biggest cost. The second major cost that you see is the rentals or lease rentals of the aircraft. Most of the companies globally these days don't keep aircrafts with themselves. They basically lease aircrafts. And so consequently, lease rentals are a big cost as well. That does kind of tell us the problems they are going to face, because airline fuel, which is something called as aviation turbine fuel, is unregulated. And when I say unregulated, the prices move in tandem with the global crude prices. And it is also, just like all other fuels in India, heavily taxed. So that's a big problem. Problem number one. Problem number two is almost all of the lease rentals, almost all of these leases are in dollar terms, right? So as the rupee depreciates, that cost also goes up. Not only does the crude price cost goes up, and consequently ATF cost goes up, lease rentals also go up. So when crude prices are going up and rupee is going down, this is like a double whammy, right? You're going to get hit on the fuel expenses. You're going to get hit on lease rentals as well. So that's the biggest chunk of the cost that is there. Obviously, it's a service industry, so employee cost is also a reasonable chunk there. And in certain cases, you will see a big finance cost as well. This particular company doesn't have too much of that, but some companies could have big financial costs in this case, right? So that's the first set of data as to, how do you make money, and what are the major costs that are there, and what kind of products an airline could have. Once you have this set of data, you could go to a second set of questions as well, which is, what is the size of this industry in India? What is the size globally? How much, do people travel globally? Is India different than the world? And any data that suggests what kind of growth is expected? Who are the major players? What are their sizes? And will the companies be able to grow profitably? There's one part about growth, the other part is about growing profitably. So that's the broad contour of what all data is existing at this point of time. In this, we will now move ahead and look at broadly putting all of this together in terms of a chart on what are the major drivers for the industry. So to get profits, which is revenue minus costs, you have to kind of divide revenue into the components of what all exists as revenue. So you get passenger revenue, cargo revenue, and food and beverage revenue. Approximately that's the spend. Costs, mainly fuel cost, leasing costs, and other costs that are there. Now passenger revenue is going to be in turn dependent on number of passengers that you can carry and average ticket price. Number of passengers is in turn going to be dependent on number of aircrafts that you have. So what kind of supply do you have? Number of departures that you have, which is what kind of routes are you basically working on? What kind of aircrafts do you have, that define the number of seats each aircraft has? And the load factor, which is what kind of utilization are you able to basically garner in this case? And that all combines together. So let's say 10 aircrafts, number of departures is, let's say, 6 departures a day, number of seats is, let's say, 180 seats, load factor is, let's say, 80%, multiply, and you'll get the number of people who are there in the flight on any day, right? Then you can look at what is the average ticket price, multiply, you get passenger revenue. Similarly, for cargo, you will look at what is the number of departures that are there, number of aircrafts, number of departures, and average tonnage per departure. For F&B, basically just find out the number of passengers, which is again going to be the same calculation, and average F&B spent per passenger. So how do you basically reach to that number? That becomes important data point. And fuel costs, again based on number of departures, average fuel price, and fuel per departure. So approximately you could calculate what is the average kilometers that a particular company has traveled, a particular airline flight has traveled, and find out fuel cost per kilometer as well. In fact, companies do report it that way. You could also just take the total fuel cost and divided by the total number of departures, and you'll get, broadly per departure what kind of fuel cost is taken. So that gives a sense. Leasing costs will basically depend on the number of aircrafts. So once you have this data with you, you will be able to kind of reconcile as to how does the airline industry end up making money and how does the airline industry basically spend money. You could basically find out what are the major drivers based on these parameters, find out these parameters, project them, you'll get a sense of where the airline is today, right? Uh, what are the challenges? Now, this is an interesting industry where there are just too many externalities involved. When I say externalities, there are businesses where a lot of the things are in your control, right? Costs are in your control. The demand is not very volatile. There aren't other concerns which kind of affect something like an airline industry. When I say externalities, there is a huge dependence on oil prices, and we'll see how much of the total cost structure comes from oil itself. There are security concerns, right? This is an industry which, whether we like it or not, is always kind of under the eye of some sort of a security concern. So that becomes a big challenge for the airline, and huge amount of cost and operational headache goes in terms of ensuring that this security is taken care of for every departure. Weather related delays. You look at a country like India, northern parts, where basically in the winter time, you will have a fog issue coming in, and a lot of flights just get delayed or cancelled purely because of a simple weather issue. Globally also, there are similar such cases where a volcanic eruption would basically go and disrupt flights passing through that route for days to come. And so weather related delays or cancellations are a big problem. Airlines can't afford them because technically they run a very high fixed cost business. Your inventory is basically the seat that you're carrying in the aircraft. And if that aircraft is not flying because of reasons such as fog or volcanic ash, there is a problem because you're losing money every minute it is on the ground. So technically you only make money when the aircraft flies. So in such a high fixed cost business where you have already leased the aircraft, let's say for the year, and your utilization doesn't work well because of these externalities, that's a problem. So that's the broad set of externalities that come in. Competition just creates a bigger challenge in the industry in itself. Now, within this industry structure, usually, if you look at sectors where price wars are common, and if you look at airlines industry, there is sort of an undifferentiated product. There is no real difference between two flights that are going from Mumbai to Delhi, other than probably time that you would want to kind of look at. And as long as the cost is not, is substantially different, you basically go for the cheaper one. So technically there is no brand loyalty that plays out. So high fixed cost business, no real brand loyalty. People look at it as a utility business. And so consequently competition is going to be high. In general, high fixed cost businesses are prone to price wars. Think telecom, think airlines, basically all the cost that was supposed to be taken, think hotels, all the cost that was supposed to be taken has been taken. Once the flight is going from Mumbai to Delhi, the cost is on. Now, whether 100 people are sitting or 110 people are sitting, the difference is not too much. In these cases, because variable cost is low and your contribution margin is what you're caring about, practically there is no variable cost of getting the next guy in. You will eventually see price wars happening whenever there is whenever there is an issue in terms of utilization, and that causes a problem around the industry. So let's look at the industry structure. Competitive rivalry is high, right? So that's probably very high because an airline is bidding for your ticket, and unless the prices are, the only way they can fight is price. Most people are not really too conscious about what services they're looking at during a 1.5 hour flight. So essentially, you are going to look at price sensitive market where competitive rivalry is high and fixed cost is huge. If you look at threat of new entrants, that is essentially low because of regulations that are there and because of the fact that it requires it's a capital intensive industry. So that is a good part about the industry, that you don't have random competition walking in at any point of time. Substitutes in a way do exist, although in terms of time and safety there is no real substitute. But substitutes for most industries usually come from other segments. And if you look at the industry dynamics, a lot of the travel is basically business travel, right? And business travel could practically be to a large extent taken care of by video conferencing facilities. The day technology allows us video conferencing to be superior and cost effective, uh, practically a lot of the air travel could start facing trouble because of that. So that's a challenge that comes in. Supplier power, if you look at the supplies, one of the biggest supplier would be oil companies, and that is, everyone is a price taker for oil. So you can't really have any kind of bargaining power against your supplier there. The second one would be the government, who would allow you where you can fly and where you cannot fly, and sometimes you try to increase prices, and that's a problem. So supplier power is typically high again. And the third probably could be airports, who will give you parking slots and all. So if you want a good parking slot, you have to pay more to the airport. So essentially supplier power becomes higher here because everyone is vying for the same asset in this case. Buyer power, usually it's a B2C business. So in general, in B2C businesses, buying power, bargaining power is low. So that's because I can't go to Jet Airways or I can't go to Indigo and say that, please cut the price for me. They won't do that. They cut the price because competitive rivalry is high and not because I exert any power there. So if I look at the scenario of Porter's five forces, this is very high. This is high. Threat of substitutes would probably be medium, but is approaching. Buyer power is low and new threat of new entrants is low. But the problem is that this one segment or this one portion, which is competitive rivalry, basically supersedes everything else. When pushed to the corner, all airlines basically fight by cutting prices, and that creates a big challenge in terms of the industry itself. And then no matter how lucrative the industry is, eventually you're just waiting for the next price war to happen, right? And that's the key challenge that this industry faces at this point of time. Now, we've looked at the challenges, we've looked at most of the data. Now let's look at some interesting data about, let's say, how is India different than the rest of the world? Now, globally, the airline industry has been, in terms of revenue terms, have been growing. In terms of profitability, this is a very big disaster globally over the years, purely because most airlines basically end up losing money. There are a handful of airlines who have basically made money ever. And one of them is in India, which is Indigo. There's another one called Southwest Airlines, which has made money most of the years of its operations in the US. But otherwise, it's a very difficult business to kind of carry out, right? So that apart, let's look at the constraints or opportunities, the Indian environment that we look at. Now, if you look at the Indian airline industry and you look at the annual domestic seats per capita, right? Our population is about 130 crore. Number of seats that are available are practically about 1/10 of that, 0.1. When you compare that to developing nations, like let's say China, that's 4 times the market of India. You look at Malaysia, that's nearly 10 times, right? So Malaysia is 10x, China is 4x. Most of the Asian, Southeast Asian guys are 4 to 5 times of us. When you look at developed economies, most of them again vary between 4 to 30 times in terms of domestic seats per capita which are available. So very clearly, the industry is a supply constrained industry, right? There isn't enough supply that is available. Now, why isn't enough supply available? There could be multiple reasons for that. Infrastructure could be one. Lack of financial ability to be able to run airlines is another one. Initially, there is lack of demand. So in such a cutthroat industry, people don't want to take risk by trying out new routes and then seeing that whether we survive for a couple of years or not, because there have been instances where either airlines have completely folded or gone very close to the verge of folding in the last 10 years, right? One has folded, two have gone very close to the verge of folding, and these were large players who were in trouble. So effectively, you don't want to put too much supply till the time you're confident that will work. And so India is a supply constrained market. In terms of departures, you look at domestic passengers, we have about 12 crore departures in the last year. This is domestic departing passengers. International departing and arriving passengers are about 6 crore. So that adds together to about 18 crore passengers on a total population of about 130 crore, which again, by any stretch of imagination or yardstick, is significantly low. I mean, technically, domestic travel is zero point 0.1 times per capita per year, and this could easily go up dramatically over the many next years to come. And so that is one of the things that has been playing out. That is one of the things that is kind of continuing. There are a couple of terms that get typically used in the airline industry as well. Something called as available seat kilometers, which is called as domestic capacity. So if a 180 seater aircraft is going to fly 1,000-kilometer flight, then you have 180,000 available seat kilometers available. And then the number of departures that are there, you can see that. And so that total number of seats available is about 134, available seat kilometers is about 134 billion, right? Domestic airline demand, which is revenue passenger kilometers. Now, out of these 180 seats, how many were occupied by a paying passenger? That's what gives you revenue passenger kilometers. So number of people who traveled during that flight is going to give you the RPK. That's basically this. The difference of these two, or the division, is going to give you the total utilization of the industry, right? That's basically some of the terms that are said and used. Now, in terms of available seat kilometers forecast, it's expected that supply is going to increase dramatically in India from 139 billion to about 230 billion. So that's a CAGR of 13% and overall growth of about 70 to 80% over the next 5 years. The passenger forecast, domestic airline, is also expected to increase at nearly about 10% CAGR from about 12 crore or 120 million to about 17 crore in the next 4 years or so. So there is a definite growth which is expected in the industry, and that's the key part about it. What has happened historically, if you look at the domestic and international passenger growth, barring 2009 financial year, which was a global crisis year, and 2013, almost all the years, with the exception of probably one or two here or there, domestic growth has been double digit. This is passenger growth year on year, right? So year on year passenger growth, domestic growth has been 15%, 20%, 12%, 20 for the last 2 years, FY16, 17, and FY18 also has been reasonably high at about 18 to 19%. Even international passenger growth has been reasonable, though sometimes in high single digits. Domestic passenger growth has practically been double digit for most of the years in the last decade and half. So there is substantial growth in domestic travel. And there is obviously reasonable growth expected in international travel, purely because if you look at the number of passengers who are traveling outside India, that's also increasing dramatically fast. So that's something that is going to look at, and that's the broader growth scenario that has been kind of witnessed in the Indian markets over the last many years, and is probably going to be expected over the next many years as well. Right? These are average data points, obviously. And so when we say per capita, obviously, the number of population that travels is not 12 crore. The population traveling could be about 3 to 4 crore. One person might be taking on average more number of flights, right? But we are working with averages. So that's broadly looking at the data that we are looking at. Now, what are the other challenges that India faces? If you look at the number of airports that India has versus the population that India has, so India has a population of 130 crore. Airports that are operational are about 346. And all of these are not even operational, honestly. Half of them are like airstrips that are there. And when you look at the population of US, which is about 33 to 35 crore, and number of airports that are operational in the US, that difference is dramatic. And so India is looking at constructing a substantial number of new airports that are going to come up. And that's basically where the supply issue or infrastructure issue is going to get resolved. So we are probably looking at resolving the infra issue, which is stopping, let's say, companies from launching flights. The demand growth is reasonable, and companies are expecting a supply of more aircrafts which are going to come in. So for example, at this point of time, Indigo has roughly about 180 odd aircrafts. SpiceJet has roughly about close to about 60 aircrafts, and both these guys themselves are like adding about 600 to 700 over the next decade and a half. So next 10 to 15 years, these guys are adding about 600 to 700 aircrafts. At this point of time, that's the order book. How much gets added obviously depends on a variety of factors in due course of time. But that's the kind of supply that's going to come in at some point of time in the near future, right? So that's the airline industry data that we have. Now let's look at some financials, and that's where the fun basically starts in the industry. So we have data for the four major players over the last 3 financial years. Air India has not yet released their 2018 annual report, so that data is not available. Some anecdotal data is available, but we're going to leave that aside. The only consistently profitable airline in India has been Indigo over this period. Their profitability is one of the higher ones. Although SpiceJet has also done well over the last 3 years. This does not obviously look at the last 6 months of performance because crude prices have gone up and that causes a challenge. Now, some interesting data points that will come out of this analysis are that cost of fuel itself is nearly, if you see, out of the total cost, out of the total expenses or total costs, cost of fuel is nearly 30 to 40% is fuel cost. And fuel cost as a percentage of revenue most of the times is also anywhere between 25 odd percent, approximately about 20-25%, in some cases even more, right? So that's where we are, and that creates a big challenge in terms of how they are working. If you look at EBITDA margins, the EBITDA margins for, let's say, an Indigo would be somewhere about 12-13%. For a SpiceJet would be about close to 10% in the last year. Jet has just barely broken even in the last year. They were operationally positive in the last couple of years, but some of this was due to exceptional items, and some of this was obviously because FY16 and FY17, the crude prices were much lower, right? So the average crude price was significantly lower in these 2 years, and that resulted in reasonable profitability that came in. FY18 is where the problem started, and crude prices kind of started going up, continuing into the current financial year, where the rupee also started creating a problem. So that's why in this particular financial year, most companies have made substantial losses at this point of time, and they are expected to make more losses till the time at least crude or rupee both stabilize at some point. Obviously crude has fallen a bit in the last week or so, but that doesn't really tell us what it will do over the next 3 to 4 months or so, right? So that's the broad structure of data that we have in terms of the numbers. Obviously Indigo and SpiceJet are slightly more profitable than the rest of them. Air India obviously carries a huge amount of debt burden, which is why EBITDA to PAT itself kills half of the business. Now to this, we are going to try and add a few more data points, which is the number of passengers that they carry and the departures that happen. That's going to give us some more interesting insights into this business in terms of how do you run this business basically, right? So if you add that up, the total number of departures for Indigo is about 3 lakh in 2017 and 3,47,000 in 2018. The passengers they carried were about 4.3 crore and 5 crore respectively. You find data for Jet Airways, you find data for SpiceJet. Jet Airways includes Jet Airways and Jetlight under the consolidated umbrella. Now what you do is you look at the revenue and you divide it by the departure. So when you look at revenue per departure, that's about rupees 6 lakhs on average for Indigo, right? And about 5.5 lakhs for SpiceJet. It's about 10 lakhs for Jet. A, because Jet is a full service carrier, so charges are higher. B, because Jet also operates international flights, so some of those numbers flow into that. Jet is a bigger player on the, then let's say Indigo and Spice are not available on the US and UK circuits, but Jet is, so obviously the averages kind of spike up there. So once a flight takes off from, let's say, Mumbai to Delhi or Mumbai to Calcutta or Mumbai to Bangalore, you know that it's going to make about 6 lakh rupees on average. That's what it's going to make. What's the cost per departure? You take the total operating costs, and these are only operating costs, doesn't include depreciation, doesn't include interest. So cost per departure varies between 5.5 lakh to 5.75 lakh for Indigo. Interestingly, SpiceJet cost per departure is actually lower. That's about 5 lakhs. Then you can look at the revenue and divide it by the number of passengers. Obviously, revenue includes cargo and food and beverages. So there is a little bit of approximation here. But to keep things simple, we just kind of divide revenue per passenger, and you get about 4,400 per ticket and 4,300 per ticket price of Indigo and Spice. Jet, once again, because it's on international circuits, goes up. Because it's on full service career kind of a play, that goes up, the number goes up. However, the cost and price for the revenue for jet per departure is almost the same. They don't make money there. Interestingly, now if I take the cost per departure and I basically divide it by the average revenue per passenger, right? Revenue per passenger, I should get my break-even point. How many people should fly this aircraft once to be able to make me a operationally break-even? So that for Indigo is roughly about 131 passengers, which for SpiceJet is about 118. So technically, with a smaller utilization, SpiceJet breaks even faster than an Indigo because cost structure is better. Obviously, this does not include some other data points, which is, for example, we are not sure at this point of time whether Indigo, what is the size of each of those flights, right? And we are not sure at this point of time that, which does an Indigo flight fly more during the day, which is, let's say it flies more hours during the day as compared to a SpiceJet flight. So it's utilized more. This is on a per departure basis analysis that we are doing. So the crux of the matter is, if a flight takes off, you need about 5 lakh rupees of revenue to even think about breaking even. And so if you have a 180 seater, it needs to be half full, with everyone on average paying 5,000 rupees a ticket for the airline to even think about making money at that point. And what that does is brings in a huge amount of operating leverage into the business. The next 10 passengers, in fact, if I actually take the number of PAT, which is about 2,000 crore, and divided by the number of passengers, which is about 5 crore, the number of profit per passenger that's going to come in is going to be remarkably interesting. In fact, if you look at the difference of these two numbers, so let's just clean this up and see the difference of these two numbers. So that's 662 minus 577, correct? And approximately, you look at that, that's about 85,000. 85,000 divided by 4415, because each passenger is paying. That's my profit, operating profit. That's what each passenger on average is paying. So I'm looking at approximately 19 people in the flight who are giving me my entire profit. If this 19 becomes 10, I lose a lot of my profitability. If this 19 becomes 25, I make a lot of my money. So theoretically, only 19 people per flight are basically making them the money. The other are purely just taking their cost into consideration. So that's how big the operating leverage of this industry is. And that's the kind of spectrum or the story that exists around this industry, right? So that's where we are with the industry data. To quickly summarize what we have, the industry per se in India has a very strong growth prospect purely because of low penetration at this point of time, and a very good demand projection purely again because of low penetration, rising affordability, rising connectivity, infra is coming in. So technically there is a sort of a double-digit demand growth expected by most estimates for the next few years. It is a supply constrained economy, and that's partly because of lack of infra, lack of airports, and partly because of lack of reasonable policies as well. For example, Government of India basically charges nearly, if you combine the total taxes of the center and the state, there's nearly 40% tax on ATF. Right now, you go back a little bit and look at these numbers. We have about what 15 crore total passengers, and average price points are kind of available here. So you look at this, you add up 20,000, 60,000, 65,000 approximately. You're going to look at the industry size being about 1 lakh crore. If the industry size is 1 lakh crore and you see that 30% is fuel, right? If the industry size is 1 lakh crore and 30% is fuel, then ATF cost is 30,000 crore, right? If ATF consumed or cost approximately 30 to 40,000 crore is what the total ATF consumption would be. If out of this there is 40% tax, then what the government is making as tax is about 12 to 15,000 crore. Right? Now do remember that the tax only gets made if someone is surviving to purchase the ATF. If the airline folds because the taxation makes it uncompetitive, and globally the tax rates are about 20%, so Indian Airlines are competing that way on a difficult footing because of this policy constraint. If this goes under GST, right, and let's say there is an 18% GST on ATF or something of that sort, you save on the airline industry itself. There is a straight saving which could translate into substantial savings, or at least efficiencies that come into the operation. The government might lose maybe half of this as tax, which is going to be probably roughly about 6,000 crore. Now 6,000 crore honestly is loose change for the government if they want to either raise money or they just want to sell the stake. Air India is actually selling 800 crore worth of land right away as we speak, right? So technically there is some policy constraint as well which needs to be handled, and that encourages more people to come and pick up airline as a business that is survivable. That's going to come in. Domestic taxes are an issue which we've just discussed, and industry competition is an issue. This will remain an issue because inherently I think whatever you try to do with this industry, at the end, there are two kinds of plays that play out. One is where there is a growth, good demand, and everyone makes money on this. And the two where there's a good growth, good demand, but the consumer makes money on this. We have seen the latter in at least the telecom space, for example. There is a good growth. There is a substantial consumption demand that is there from people that has happened, let's say, on the data space. But companies have not made money. It is quite possible that in high fixed cost businesses, that is what plays out. And while the consumer benefits in the long run, the companies do not because of the inherent structure. But if you resolve a few of these things, which is supply constraints and domestic taxes, and honestly, over a period of time, probably the dependence on fuel itself may go down purely because there are more efficient engines that are built, and probably the dependence on crude itself goes down as we start using hybrid engines across industries. So let's see what is in store for us in the airline industry. But that's broadly what we wanted to kind of discuss in this particular session. There's loads more to kind of go and look at. As a next step, you could just go and look at some of the annual reports of some of these companies, try and read a little bit more about the government incentivizing regional connectivity, read a little bit about how globally this industry has played out, and how some of these companies have tried and done cost cutting in India. It's an interesting, relevant, required business in every economy, but for some reason doesn't end up making money in most of the economies. India might be slightly different purely given the demographic profile and the under-penetration of the industry. And if somehow the industry can find a way to exert a little bit of pricing discipline, then you could see reasonable growth in terms of profitability as well for some of these airlines for a fair bit of time. Having said that, it does remain a fixed cost business, so we have to be careful about that. So that's broadly it in this particular session.